What is net worth? I didn't know what that was. Like, I own some houses, have some equity. I'd never done a personal financial statement.
Sure.
You know,
and how many people think that? How many people think, oh, this is going to be great. I'm going to have somebody live in my property, and they buy a single family house, and somebody lives in the property. The market changes, tenant moves out, they can't rent the house, and now they're paying $2,000 a month out of their pocket.
Welcome to the Captain Curt Show. I'm your host, Curt Marker, where we talk business, real estate, and building wealth that anybody can achieve a financial freedom lifestyle. All right, welcome back to this week's episode of the Captain Curt Show. I've got a really special guest that I met a couple months ago out in Scottsdale, Arizona, and he has such an interesting story, 30 years in real estate, so he's got me by a lot of years, and I hope you guys learn a lot from this episode. And I got Mike Morawski down here from Huntington Beach, about an hour drive, so thanks for driving down.
Yeah, it was great. It's a little closer than going to Scottsdale.
Yeah, I flew out there for that event. Actually, you know, it's funny, I was there doing something else, and I saw that pop up, and I'm like, oh man, I'm going to land at 3 o'clock, and I drove straight there.
Yeah.
And Dalen and those guys put on a pretty cool event.
Yeah, Dalen and Paul do put a good event on.
Yeah.
They have a great mousetrap.
Yeah,
for
sure.
sure.
And I like their product. I've kind of slowed down on the capital raising as I'm looking for my next deal. And so, you know, I have a good relationship with those guys. I'm like, as soon as I'm ready and know where I'm going, I'll get back to you. But
you know what they say about slowing down, though? The best time to raise is in between deals when you're not under the gun.
You are right. That is right. Yeah. So I'd be happy to get into some capital raising. You know, you're mostly an expert in that. But I'd like to start out. So you've been in real estate for over 30 years. What keeps you fired up today after 30 years in real estate?
Yeah, you know, that's a funny question, right? So I was sitting next to a guy the other night. He's in his 60s, and I'm in my 60s, and he said he was thinking about retiring, and I was like, damn, you know, it might be nice to slow down, but you know, I feel like I'm just gearing up again. And one of the things today, so the easiest way to answer that question today, one of the things is, been in the business 30 years. I've seen these cycles, right? And I've always said, damn, I missed it. Why didn't I see it coming? And what I mean by that is, why didn't I see it starting to swing up again? Why didn't I get in front of that? And I think a lot of investors today are sitting on the sidelines and they're waiting for the market to change. But by the time it changes and you notice it, it's already over here and you missed it. And what keeps me going today is the fact that I'm right in front of it. And I know that over the next few months, this market's going to start to cycle up. And over the next couple of years, it's going to be that perfect time. And timing's everything. And if you can get in front of this next bull run, you know, you could create a lot of money. I think there's going to be a lot of new millionaires created and a big redistribution of wealth in this country.
Yeah, I think you answered that perfectly, and it's something I've seen in my experience. I've been in real estate 10 years, let's say, and in 2020, right before COVID hit, I went out and bought a couple STRs, short-term rentals, right? Little tax play because I'm a high W-2 income earner, so it's a great little tax play.
Oh, I got something for you.
I can't wait to hear it. But a lot of my friends said, hey, it's risky. They were like, we're in under contracts, and I closed on 2 houses like in March during COVID, right? But I knew the market so well. I'm like, I've been looking at this market for 3 years, and you know, a lot of my friends said, "Oh, wait, we don't know. It's uncertainty." Well, I'll tell you what. After I bought that house, which has doubled in value, it doubled in value in about 2 years because the market took off.
Right.
I especially made a lot of money because those were in Arizona, which people were leaving California during COVID just to kind of have a little bit of freedom, which they had. But if I wouldn't have done that, I would have lost out on numerous different deals because I was able to cash out refi, remodel, reappraise, all this, and then I use that money elsewhere in future deals. So I agree with you. The people that are sitting on the sideline, I think the average investor kind of waits where it's like maybe too late. They can still make some money, but they don't hit the home run.
Right.
Where if you're always in the game and you're always researching and keeping your, you know, we may not be buying deals every month, but it's like we're looking at them for sure and to see what the market's doing. So to me, that's what keeps me excited, but you got to be ahead of the game.
Yeah. Yeah, I tell people today, how long are you going to sit on the sidelines? How long are you going to wait for that change to happen? Because normally when you realize that change happens, it's already happened.
Mm-hmm.
You know.
Yeah, and I agree with you. I think in the next now for the next 3 years, I think is a great time. There's going to be some great assets. I mean, I've seen some multifamily stuff on discounts right now. Yeah. Certain markets, and people that got loans in 2021 that can't really refi right now. One of my friends, he has 18 good deals. He's got one bad one. Yeah. He goes, we're going to lose our butt on one of them, and he's like, there's nothing we can do. The bank won't work with us. It happens, and in the market, the one market. But people that I know, for me, like, I never really sat on the sideline. I kind of did my research, believed in myself, and went for it. And I did all my own investments first and kind of proved my concept before I started bringing in friends and family money, and then proved that concept, and then felt comfortable to really open up kind of an investment firm only a couple years ago. But I think it's really important for when you're taking in investor capital like we do, it's really important to have a proven strategy and have an exit plan. Right. And I mean, so you're mostly in multifamily right now. What is your exit strategy for most of your projects?
Yeah, so our strategy is typically 4 to 5 year hold. Money doubles at 15% in 4 years, right? So my goal for my investors is that we can double their money in 4 to 5 years. And, preferred return, long-term equity play in the deals. And so I want to be in a deal 4 to 5 years. 5 years is typically the sweet spot. Now, got a couple bad deals right now that we're going to have to hold a little bit longer, But, we have a deal right now, our original projection on it was hold it for 7 years. But now we figured that if we hold it for 2.5 more years, almost 10 years, that we're going to do better than we originally anticipated. So why not hold it a little bit longer, get some people a little bit more cash back. And so that's the main exit plan, is 4 to 5 years. But what I will say is if you're in a deal and you've got a 6% interest rate or a 6.5% interest rate today, and these interest rates come down in the 5s again, it's going to make sense to go refinance. So I never write that into my underwriting, just because I don't want to promise you, Curt, that, hey, we're going to refinance this thing in 3 years. But the market cycles every 5 years. And, there's a philosophy around holding that deal for 20 years and refinancing every 5 years and pulling capital out. So, I think there's different mentalities around it, but, I like the 4 or 5 year sell out, move on to the next one.
Yeah, and I think there's so many different strategies, but I think the key, you hit the nail on the head right there, is protecting investors' money, even in a bad deal, and you're just being flexible, right? The goal is to make sure, number one, investors get all their money back, and we want to get them as much profit as we can. And I like to be very clear with my investors, hey, these are projections.
Right.
This is what we're thinking, and it's even conservative, where my projection of my own business is higher, but then I only project lower in my underwriting. Yeah. So it's ultra conservative, where maybe there's an extra $1 million in there, but I don't even want to project that.
Yeah.
If I can 3x their money in 7 to 10 years, but in the back of my head it might be 4, I don't tell them it might be 4.
Right.
And I think there's some operators that do that, where they'll over project and they won't even hit the numbers. And people will call me that know me, go, well, why? How can I get this at this deal? I don't know how they're getting those numbers.
Curt, you got to be conservative, right? It's even like you can get the data, right? So we can go to CoStar or we can go to Real Analytics and we can buy data and we can see rent projections. And I always like to use this example because because the rent projection says that, hey, we're going to, over the next 12 months, over the next 24 months, rents are going to increase 4%, 4.5%, depending on the market you're in, right? Do I want to underwrite like that? Probably not, especially in today's environment. I want to be a little bit more conservative, right? So when I underwrite, I want to look at something and say, well, if the data's telling me I can be at 3.5, 3.7 on rent increases, I think I'm going to hold firm at 3%, right? It's opportunistic, but yet it's conservative, right?
Yeah, and I do the same, especially I'm more on the industrial side now. So we were looking at lease rates. We rent to businesses. But at the same time, if we have a refi strategy, I'm adding a point to a 1.5 on that interest rate. Right. So if interest rates are at 7 right now, or it's really 8, in an industrial development side, 8.5. Like I put the refi at 9.5. Worst case scenario.
Right.
Best case scenario, rates go down, which I think they will in the next year or two, but I don't want to underwrite for that. So if rates go for where my underwriting is at 9.5, and if rates are 7, now the investors just get an extra base hit, extra double, and that makes a big difference.
Yeah. Well, I think, rates, here's what's interesting. I've been in real estate 30 years. When I got in real estate, we were just coming out of double digits, right? And I can remember always thinking, man, I wish I could buy a house at what my parents bought a house at, have a 3% mortgage or a 2.5% mortgage, and never thinking that it would ever go back to that, right? Because we're at 10% in the 90s. And, what happened to rates? Well, it took 50 years for them to come down in that 2.5%, 3%, 3.5% range. And now they're back up. And now everybody's like bitching, right? That they're too high. Well, 6%, 7% is normal. And, you just need to learn to operate in that environment. Do I think rates are going to come down? I believe they will. We've both been at this a while. You've seen cycles. Rates are going to come back into 5s. Are they going to go to 4? Probably not. Are they going to go into the 4s? Probably not. But I think we're going to see mid 5s. And actually thought we were going to see it this year. But I think that with the administration and the tariffs and that, I think the feds are just looking to kind of let's see how things shake out here a little bit before.
Yeah, I totally agree. And I think it's probably a pretty common question we get from anyone that's interested in real estate. Right. Is like, what do you think about the rate environment? Well, we watch it very closely because we have millions of dollars in loans that are, rely on it. If it's a 5-year loan, or I got some development loans that are 12 months with a 6-month extension. It's like, well, I need to figure out where they're going to be in 12 months, and that's where the underwriting comes in. But I get that question a lot, and it's like, I'm the same as you. I thought they would come down a little bit this year. I don't think they will. If they do, it'd be December, but it's not going to be enough. It's going to be a quarter point, and I think you're right on the target. We might see high 4s in 2 years, but there's too many variables. So you can't just sit on the sideline praying to see a 4.7. I know people that they want to buy their first house. It's 6 and 6.5%. Buy it now.
Yeah.
And when it goes down, refi it in 12 months.
Exactly.
There's less competition with a higher interest rate.
Yep.
And it's the same in commercial real estate.
Well, here's the other thing too. When I buy a deal, if I can be in a positive yield position, I know I'm going to be okay, right? So if I have a good equity tranche, call it 65% LTV, and I'm in a positive yield position where, the cap rate's maybe a 7, but I got a 6.5 interest rate, even that 50 basis points give you enough cushion that you're going to be able to operate okay, at least break even. Right?
Yeah, and especially if you have a value add play.
Right.
So if you can, remodel the apartments, add some amenities, and increase the rent, now it's even looking better. So you kind of have a double
and
buffer.
Remember, you can assume stuff. I mean, we bought several hundred units in Tulsa in 2024, and we assumed mortgages under 4%.
Wow.
Were
those off-market deals or through a broker?
Well, a couple hundred units that we did buy were off-market. Broker called, said, hey, I got this pocket listing. Let's hear about it. It was a bag of problems, but, we've turned the corner on it. So
yeah, and I think broker relationships and having credibility and the ability to close and perform, that makes all the difference when you come to commercial.
Relationships, period. I think this business is built on relationships. Heck, you and I would never be sitting here doing this if we hadn't met each other, and I don't know if it was you or me, but one of us connected on Instagram before we met in person. And, I was always intrigued by, Captain Curt, right? So, it is about relationship. So.
Yeah, and I think that for me, I'm a relationship person. So I think that's what drew me into real estate. Yeah, you can learn a lot on your own. I spend a lot of time reading books, podcasts. That's how I spend my free time, right?
Yeah.
I don't watch that much Netflix unless I want to relax on a flight. Most of the time, it's like I want to learn and learn and learn, and that's why I have this podcast. I mean, we're here today, like you said, networking, but also learning about each other. And we may never do a deal together, but we may benefit from each other.
Oh, but we might.
There you go. That's also true. So
I have some tax benefits.
There you go. Yeah, exactly. And I'm probably going to need them this year. Let me tell you, because I do a lot of development and sell right now.
Okay.
And I've sold some assets this year, and I have I'm making good money at my W-2. So I have a tax strategist, but it's definitely something I got to continue to look at. So for me, I'm not buying a lot of existing deals. They're just more competitive. So to build and sell, we build and sell like condos, but it's industrial. Okay. And the market's it's newer. The concept is newer, but the returns are just really, really good. But I pay higher taxes because we build to sell. We don't build to lease.
Right.
But that's where something I have to get better at and really focus on planning about right now. Like I'll probably have a call in August. Usually my tax strategist says, hey, in October, have all your books done and let's have a meeting and figure it out.
Great plan.
It works.
Great plan.
But I'm like, if I need to get into a deal for the tax benefits, I need to start looking in September, and I got 4 months. Because some people literally will call in December, hey, I need to move. I got to put some money away. I get that, but I don't want to be in that position.
Right.
Where you know.
I think too many people start planning their taxes in October. Oh my God, I made way too much money this year. What am I going to do? And then October shows up and it's Halloween and people are scrambling and can't get into a deal in time. I started doing a couple of webinars in January this year about, hey, don't wait. Because I had 4 or 5 investors late last year that were like, oh my God, I need a place to get some depreciation. And, got in late, still were able to get the depreciation. But it made me think, there's so many people that are late to the party, right? Let's get started early. And I know you're not thinking about it in January or February, but, think about it earlier in the year and take that stress off you. If you know you're going to make $100,000 more than you made last year, how are you going to keep more of it? Mm-hmm. So
yeah, and I think a lot of people, and even I didn't realize, it's not how much you make, it's how much you keep.
Right.
So sometimes it might benefit certain people to not work as hard or hire a tax strategist.
Right.
I still like working hard, so I never want to take my foot off the gas. I may work a little smarter, but not as hard. A tax strategist solves everything.
Yeah.
Because people ask me, hey, do you have a good CPA? I do, but I also have a tax strategist. So there's they're almost two different roles. Some CPAs are just, they know the tax code and that's it.
Yep.
They don't have a strategy on how to minimize and this and that. So I think people, when they start getting into building wealth or they want to save and they want to start doing real estate, half the game is depreciation and taxes.
Right.
They look at hey, I have a couple $100,000 in my IRA or whatever. I want some monthly cash flow. That's great. Yep. But honestly, sometimes the depreciation is even a bigger benefit. And that's one of the reasons I love real estate.
Well, I don't think people realize how much it adds to your cash flow, because it does add a few extra dollars to your cash flow. Mm-hmm. And if you can have a few extra dollars at the end of the year, why not?
Yeah. And so we bought a hotel. I'm a GP, like a main partner in a hotel. I don't operate it because I'm not an expert in a hotel. My partner operates it. And I think I put $300,000. We closed in December. We wanted to close for taxes. And I put $300,000 into that deal. And we did a cost seg study. And it was we got 83% tax depreciation on that deal.
Yep.
I got $240,000 in credit or whatever it was at my account. I said, so instead, where the year before, I went out and my accountant's like, hey, go buy a new phone, buy a new laptop, buy the business things, which is great, but it ain't 82% write-off.
Right.
And that's what people don't necessarily understand.
So I had a chiropractor last year, and this is an interesting little story, right? So I have a couple of coaching clients that are chiropractors, and we've been going around to these events, seminars, conferences, all chiropractic. And it's interesting, we're the only financial services provider at these events. It's just crazy. So, but I met a chiropractor last year, and he said, he was so happy. He said, I just spent $800,000 on a lake house. I paid cash for it. I said, why'd you do that? he looked at me like, what do you mean? And I said, look, I said, you spent $800,000. What's that money doing for you right now? Well, it's going to go up in equity. I said, so if it goes up 3% a year, what have you made? I said, inflation, at the time, inflation was like 7%. I said, you're actually losing 4%, right? And he didn't understand it. I said, look, here's the difference. What if you went right now, refinanced that, did a $400,000 cash out refinance? He goes, yeah, but I'm going to have an interest rate of 7%. I said, that's okay. I said, you're going to get cash flow of 7% on the other 400. It's going to offset that interest and mortgage payment, right? Plus, you have equity in another deal. Plus, you get depreciation, tax benefits. I said, you're ahead of the game at least 12% after you pay the interest on the other property. And he was like, really?
Yeah, and I think you hit it. The education isn't out there.
Right.
And I mean, there's other people just like us doing the same thing, but it's how do you get to those people?
Yeah.
There's a lot of people in this country that make a lot of money. And in my opinion, depending on where you live, if you're someone or a family that makes more than $200,000, in Southern California, it might be a little tougher because properties are so expensive, but there are plenty of people that have enough capital to invest, whether it's 50 grand, 100 grand, whatever. But like you said, that lake house using leverage is a great idea. Buy the lake house, put 200 grand down if you want to,
right?
And then take a loan on 600 at 7% and go invest it, make 15% a year.
Yeah, but how many people are out there like that? They own a couple houses. One might be paid for. Two of them might be paid for, and they have that equity, just sitting there.
Yeah, and what's funny is when I got into real estate, I read a couple books, and I felt like even at that time for me, the American dream was to have a couple rental properties that would eventually pay themselves off in 28 to 30 years,
right.
Let the renters pay them off, and then in 30 years when you're retired and whatever age, now you got money coming in. But really, it's not necessarily the American dream once you actually get into investing and you start seeing the return on capital and the equity. I mean, I had houses double in value in 4 to 5 years,
right,
because of market timing, but I took that risk.
Right.
And then once you start seeing the rewards from it, it just opens your eyes to bigger things.
Well, you're back to market cycles. Right?
There you go.
Which what we were talking about a few minutes ago. Mm-hmm. And, I have a good friend and the famous line is, there's no geniuses in this business. There's only market cycles. And it's so true.
I love that line. The other thing I've heard too is anybody can do real estate. It just takes some effort.
Yeah.
You do not have to be a genius. You don't have to be this tech rich person. Right. It's for anybody that is willing to put in the effort.
Right. And if somebody doesn't want to do real estate because maybe they love their job, or maybe they're retired and they're loving life the way it is, and they don't want the tenants, trash, and toilets, right? Then people like us can help them, right? Because they can put capital in an industrial deal, a hotel, a multifamily deal, where they can get cash flow and build some more wealth along the way.
Yeah, and they call that, passive investors or limited partners. They're actually a partner in the deal.
Right.
They just don't have to answer the phone when a tenant calls when the toilet's broken.
Right.
And I have a friend of mine who's an investor with me in a couple deals. He called me yesterday, actually. I haven't talked to him in a little while. It was nice to catch up. And he said, hey, I got this 4-unit in Kentucky, and I got this 4-unit over here. He's in a couple syndications with me, but then he started buying his own. And he goes, well, I'm kind of tired of answering the phone. The property managers aren't great that he hired. He goes, they're not filling the units. And I go, you have to manage the property manager. So when someone says, hey, I just going to hire a property manager, then it's passive. That's not true. It's just not true. If you have to manage the manager. So his phone call to me was, I think I'm going to sell them, like the units. He goes, I'm just kind of tired of it. He goes, I'd rather just syndicate with you and just put into more syndications. Right. I go, and honestly, I don't know the numbers. I bet you he makes more in the syndications with me than he does on all the headaches and even on the property.
Yeah.
Because the deals we go after are not these 8 to 10% deals. I'm sure you're looking at 15%, or what's your target market in multifamily?
Yeah, I try to bring something to the market that my investors will see a 17% per year, projected IRR. and get 7 to 8% cash on cash along the way.
Yeah, and to me that outpaces the stock market.
Of course.
Obviously the stock market has swings, and I read a stat. Oh, it was up 20% one year, and I'm like, great, but look at the 10-year average.
What happened the year before and the year after?
Exactly.
Right?
Yeah.
And look at the 30-year average, because I just looked at a chart. We did a webinar, and I looked at a chart, and it was like the 30-year average was right about 8.25%, but real estate was at 9 to 12.
Yep.
So real estate outperforms traditional investing, no doubt.
And it comes with the tax benefits. I mean,
Right.
So that's not
Which
counting
you don't
it.
get in the stock market. Yeah.
Exactly. So I don't know about you, but I used to do some stock market. I was definitely trading a lot during COVID because there was some opportunity.
Yeah.
But I have $0 in the stock market anymore. Once I started really making money in real estate, I said, I'm going all in on this.
Yeah, and I'll say something about that. So I've always been a real estate guy, right? And there's a time in my life I got wiped out because I was all real estate. And, I believe in diversification. Now, a couple different ways, though. Yes, you should have some traditional diversification. Be in stocks and bonds. Be in some alternative investments like real estate, gas, and oil. But when you're in real estate, the diversification comes around being in an industrial deal, being in a multifamily deal, being in some self-storage or a hotel, right? So that's where the diversification comes in the alternative investing piece, which, I don't know that a lot of people equate that to, diversification.
Yeah, they look at real estate as a lump sum.
Right.
And for me,
right.
I am diversified, like you said.
Yeah.
It's all real estate.
Yeah.
But it's hotel, industrial buildings. I got a mobile home park. I'm selling a lot of assets that I want out of.
Yeah.
But now we're looking at launching a car wash fund.
Yeah.
Why is that? Because my friend who's been in real estate a long time is building car washes, and they're doing very, very well.
Well, here's the other thing. There's some fun stuff out there. Like I got a buddy, he's a partner in the Waldorf in Vegas, right? So he owns a piece of that. So how cool is it to say to your buddy, hey, you know what? Let's go to my hotel and have a drink and take him to the Waldorf, right? I mean, there's some cool real estate stuff that you can be invested in, even just as a passive investor, because you can say, hey, I own that. I own a piece of that, right?
Yeah, and I like doing it. It's
Yeah.
kind of like a credibility, or like you said, fun. But I also worked really hard to get the money to invest in it. And like you said, our hotel is out in the Smoky Mountains of Tennessee.
Yeah.
I love going there. It's beautiful. We just spent $3.5 million on a renovation. It's got 3 pools.
Yeah.
We built a speakeasy. It's like a great family place next to the Smoky Mountains, which is just an awesome area anyway. But
Yeah.
I like real estate because it's tangible.
Yeah.
I'm hosting my first ever investor event in Houston, where I'm mostly building right now, and in October. And investors are going to come out, and we're going to play a round of golf. I don't golf much, but I'm getting back into it because it seems like all my investors golf. So we're doing a country club morning golf for fun, and then we're touring our developments.
Nice.
So the investors that invested in the deals and investors that are just interested in what we're doing are invited to come out. We're doing a catered lunch at the flex space we're building. Okay. Just a good way to connect and let people see it. Like, look, this is what we build, and these are the businesses that are leasing and buying from us.
Yeah.
So I think it's a cool way to connect with people. And if people aren't investing, I think hopping on a webinar, getting on YouTube and just learning about it rather than listening to what their friend says or what their mom says.
Right.
Like, do your own due diligence and do some of your own learning. And like you said, get off the sideline and go get it, because there's a lot of money to be made in real estate.
Yeah.
So I saw that you've raised millions of dollars. You've controlled over $450 million in real estate. What do you think is like your most complex deal?
My first deal. So I spent like 15 years selling residential real estate. I mean, I had a team. We sold about 125 houses a year. We did really well. 2005, I thought, and I'd always wanted to go into the apartment business. I lived in Chicago at the time. I was in the construction business before that. And I did a lot of work for a couple apartment syndicators. Sam Zell's old company, Equity Residential and Inland Real Estate. And, I always understood this, Curt. You raise private equity from the individual, you marry it with a great real estate deal, you stay in the middle, And as long as everything goes well, everybody makes money. But the hardest deal I think I did was my first one, because I thought, I know enough about doing this. I understand the model. I know enough about real estate. I went in the real estate business, and the first time somebody said cap rate, NOI, yield maintenance, I went, what are you talking about, right? I had no clue. So I had to relearn all my own new language. And so I did that first deal, and I learned a lot because I didn't do any due diligence. I didn't do any market evaluation. I didn't do tenant evaluation. I didn't do any preliminaries on the property. I just listened to the seller. The seller said, hey, you can go in, put a new boiler on, a new roof on, fix the balconies, resurface the parking lot, put some exterior lighting up, and you'll be able to rehab the units, move new tenants in, raise the rents $150. I thought, shit, I'm in, right? And I got into that deal, and I did all that. I put a boiler in, I fixed the balconies, resurfaced the parking lot, put a new roof on the building, rehabbed the units, and I got the same crappy tenants. And I couldn't raise the rents. And if I did raise the rents, they paid the first month and didn't pay after that, and I had to evict them. And so that was the hardest lesson I learned, was that I didn't know what I didn't know at the time. And, I lived in that space for a while. But then I went and did the next deal, and I knew a little bit more, and I had gotten some coaching, and I had gotten some people around me that knew the business and kind of walked through some models with me. And then it became easier, and the next one became easier. Do I have difficult deals? Yeah, I think, we're in a market cycle. You have a couple difficult deals, right? Cash isn't there. People aren't paying rent. Delinquencies are high. Deals are made and broke at the asset management level. So this is a people business. So we have to, watch the people that work for us.
Yeah, and I think you're really correct on that. Where also, as like a newer investor, I didn't realize, yes, it's a real estate asset, but it's still a business.
Yeah,
you need to keep your eye on P&Ls. You need to look at expenses. How can we cut them? What's going up? Property taxes, insurance have gone up. There's a lot of moving parts to where when I got in the business, that's what I thought.
Yeah.
Okay, this thing needs a rehab. I can increase it like I did with my small multifamily, 2 and 4 units that I was first buying. But once I got into commercial, it was the lending and the banks are a lot more difficult. You got to have net worth. What is net worth? I didn't know what that was. I own some houses, have some equity. I'd never done a personal financial statement.
Sure. And how many people think that? How many people think, oh, this is going to be great. I'm going to have somebody live in my property, and they buy a single family house, and somebody lives in the property. The market changes. Tenant moves out. They can't rent the house, and now they're paying $2,000 a month out of their pocket for the mortgage payment. And they go, what did I do this for? Right? So they're not making any money. Where, there's economies of scale with multifamily. We do, you do more units when you're involved as a limited partner. It's more beneficial for you because now you're not taking care of that. And I've had a lot of investors like your friend, with the deals in Kentucky, right? Where he said, I'm going to sell these.
I hope you guys are enjoying this week's episode of the Captain Curt Show. I'd like to take a quick minute for you that are listening that want to get started in investing in real estate, but you don't know how, or you don't want to answer the calls for all the tenants that call you with leaky toilets and other issues. My company, Captain Capital, is buying commercial real estate assets with limited partners just like yourself. If you're an accredited investor, meaning you make more than $200,000 a year, or you have a net worth of over $1 million, go to our website, captaincapital.com/invest. Fill out our investment form so you can see our next investment opportunities. Now, back to the show.
And there's a lot of investors that have said that, I'm going to liquidate my single family stuff, and I'm going to just, invest as a limited partner.
Yeah, I learned that early on. I went through something in California here, and I had a duplex. I lived on one side, rented the other side out. She must have lost her job, stopped paying rent. And in California, court's not very fun, I'll tell you that. It doesn't matter how good of a landlord I was. I literally lived next door. And she stopped paying, had to go to court, lost in court. For no reason, really. And it made it difficult. So I decided, okay, no more investing in single family. at all, or in California. So, I mean, all of my investments are outside. Besides, I have a house here, but I don't own any rentals in California. But I do love the idea of economies of scale. If you have a multifamily complex and 5 people don't pay, but you got 100 units, it barely affects it.
Right.
Where if you have a house, let's say you have, we're here in Carlsbad. Most houses are $1 million. So let's say you have one house and you got a mortgage of $7,000 a month, and then that person loses their job and they stop paying, and you literally will file to go to court, and you may not win like me. Now you're out like 40 grand in 6 months really quickly. Now your savings account is getting drained. Right. So the risk is higher. And so a lot of people, I hear the same. I got one rental house, kind of a pain in the butt, or I have 2 or 3. And you know what happened to me? I sat down with a friend who's a smart businessman. And he goes, hey, how much are you cash flowing on that house that you moved out of? And I go, I rented to a friend who takes care of it. Cash flowing like $1,000 a month. And it's okay. It's good. I have 21 years or whatever.
That's good cash flow on a single family house.
It was. And so I was like, it's nice. It's paying my rent on the beach where I was, right? Anyways, long story short, he goes, well, how much equity you got? And I go, $350. And he goes, can you make more than $1,000 a month if you sold the house and you took the $350 out? And I go, oh yeah, like 3 or 4 times that.
Yeah.
And I was right. But he was the one that opened my eyes to that.
Sure.
Now I'm telling investors, where's your equity? And these are like, some of them are experienced investors with 4 or 5 houses.
Right.
These are conversations I'm having, but it's something I had to learn from someone else.
Yeah.
So and that's what happened to me. I cashed out my first duplex and then went and bought a bunch more, and it went well. And that's what I'm hearing from people. Their equity's trapped. And it's, and they're having to deal with the toilets and the renters not paying and this and that. And I don't know about you. I like having people that work for me to deal with that stuff.
Yeah, right.
I mean,
me too.
You be my partner. I don't want to deal with evictions. I dealt with a lot of them. But what's the first thing someone should look for, like when evaluating a multifamily property?
Oh, that's a great question. So I was kind of going to touch on this so let me just back up for a minute. You said you don't invest in California, and I get that, right? So there's this thing, red state, blue state, right? And you want to invest in a market that is a landlord-friendly market, right? And I lived in Chicago forever, and Chicago's not landlord-friendly. I did one deal there in the multifamily business, and I knew right away I wasn't going to make any money there. So we started to invest in Dallas. I own 2,700 units in the Dallas market. We own property in Florida and northern Alabama and the Ohio Valley, but no more in Chicago, right? So we look at markets. I'm a market-driven investor, and we have this thing called market traps. So, it's population growth. If the population growth going up, because if it's just sitting flat, it's going backwards. It's got to be trending up. Job growth. Well, job growth is spurred on just because of population growth. And then there's household income. Where is that at? Will the household income substantiate me wanting to raise my rent $500 a month if I want to do, if that's where I'm headed? And then the big thing for me today is, because back in the early 2000s, I owned about 4,000 units in 5 markets, and I managed about 7,500 units. When the market got hit, our biggest losses were in the Ohio Valley because there were only 2 employers in those markets. And today I won't invest in markets unless there's multiple employers, because in those 2 employers in the Ohio Valley, we had distribution. So like UPS and DHL were there. And when the markets got hit and all the transportation got hit, all those businesses laid people off. People didn't have jobs, so they moved out of apartments. They doubled up. They went back home. They didn't need a place to rent. And the automotive industry. So today I watch employment markets more. So I want to be in a market that has multiple employers. So like I'm in Tulsa. In the Tulsa market, we have aerodynamics, medical, manufacturing, entertainment, distribution, retail, technology, manufacturing, and entertainment. And so I have 9 different employers. So if entertainment gets hurt or distribution gets hurt, I still have technology and I still have retail that's going on that could outweigh that, right? So I'm not going to get hit as bad. So those are the first key drivers for me when I look at a market and head into a market. And there's about 8 or 10 of them that we look at pretty consistently. And if we can't check the box on those, we won't even buy a deal in that market. We won't even look in that market. And we monitor about 40 submarkets around the country. And so it's really based on the market, because you could bring me a great deal in Chicago and I would say no. But you could bring me a bad, questionable deal in a great market like Tampa, Florida, or Tulsa, Oklahoma, or Dallas, Texas, and I would look at that deal. So
what's your favorite current market right now that you're looking at, and why?
So we bought last year about 400 units, 350 units in Tulsa, Oklahoma. I like Tulsa for all the reasons I just talked about. But, I still have some markets that I really like Dallas, Texas. Dallas is a great market. It's just pricing is distorted right now. So Dallas is a great market to be in. I like Central Florida. So I like from Tampa to Orlando, that whole stretch, that corridor there. I like Northern Alabama, Huntsville, Decatur, Madison, because, it's just, those are markets where people move to because of lifestyle and they retire and there's a lot going on. Plus, they're landlord friendly.
Yeah, I agree. What's something investors are overlooking right now in today's market?
It's like we talked about in the beginning. I think they're overlooking where we're at in the market cycle. I really believe that. And I can't stress enough to investors, get off the sidelines already. Put your capital to work. There's several $1 trillion of capital sitting on the sidelines today. I can't remember. I have a good friend who's manages IRAs, self-directed IRAs. And she was telling me about a number that was just in the trillions of IRA money that's just sitting there. Come off the sidelines. Whether you have capital on the side, whether you have an IRA, get it working for you right now, because the sooner you put it to work, the sooner it's going to be able to grow for you.
I love the self-directed IRAs. I use my own personally. I'm a pilot, as a part-time job. And so I literally have a lot of pilot investors, and it's one of my favorite things to educate on.
Yeah.
And even though I'm newer at it, I read a self-directed IRA book by a really credited person, Matt, at a directed IRA. And it's like, he's a tax attorney.
Yeah.
That's the perfect person to learn from. And like I said, I use my own personal self-directed IRA to test it and learn about it. And then I put some of that into my hotel. And now people that either have left a job, some of them forget that they rolled their 401k over and it's literally just sitting there.
Right.
Some's not even into a mutual fund or anything. I'm seeing a lot of that out there. Yeah, I heard a number. I think I read some number that was like in the billions of money on the side. And it was at the event you were at, actually. It was the directed IRA guys. Nate and another guy were there. And they said, "Oh no, it's like 3 trillion." And I went, I'm way off. I thought
it's in the trillions. For sure.
It's wild. And I think, it's something I want to do more webinars on. I have an ebook coming out that I'm a little slow on. And it's just for normal people. Like, if you have an old job and you have an IRA sitting there, a 401k, just roll it over and you can control it, and the earnings are tax-free after that.
Right.
It's one of my favorite real estate plays. And like you said, there's so much money sitting on the sideline. The other thing that I found out, my dad just retired as an airline pilot at 65 years old. Well, a lot of his friends are 60, 61, 63, getting closer to retirement, right? Another hack on that self-directed IRA is at 59 and a half. No matter what company you work for, you can move your current 401k over to an IRA, a portion of it or the whole thing. So it's not just, and like my job, if I have a small 401k, because I don't fly that much, so I have a little bit of money in there, they won't allow me to roll it over. It's their deal. But once you hit 59 and a half, you can do whatever you want.
Yeah.
It's a federal rule, not like a company policy. Some companies will allow you to roll some of it out if you're a current employee.
Yeah.
And I need to learn a little bit more to make sure I'm on point if the rules have changed this year or not. And I really want to educate a lot more, because I think that's just a hack to real estate investing.
Right. Well, borrow against your 401. Go in and borrow the money. Yes, you have to pay an interest rate on it, but if your deal's throwing off 7 or 8% cash flow, and that is minimal IRS required interest of 3%, call it, you're still money ahead.
And you're paying yourself the interest.
Right.
And then you also have the equity gain.
Right.
So there's a couple variables there that are just great.
There's big advantages to being able to do that.
Yeah. And I hope people kind of that are listening now is like, look into your 401k or IRA as a future plan.
Right.
You may look in your bank account and go, I really need to save that 50 or 100,000 that's in my savings. I get that. But look where else you might have some hidden money that you literally forgot about. It's a big deal. I'd like to touch on, so when I met you, you told a story of how you went to prison. And so you went through a serious valley, 10 years in prison. Is that right?
I got sentenced to 10 years. I served 8.
Okay.
Yeah.
So what happened exactly?
Yeah. So, I talked a minute ago about I was in the construction business. I went into real estate, went in the apartment business. I'm a little bit of an overachiever. So I scaled a $100 million company in 30 months. We bought 4,000 apartments, wound up managing 7,500 units in 5 markets around the country. I built a pretty substantial company in a very short period of time. And when I tell my story, I talk about 5 mistakes I made. Grew way too fast as a company. I was over leveraged. I owned, $60 million worth of real estate at 85% LTV, where I should have been at 65. I coach people today and tell them, don't do a deal unless you're 65% loan to value. I was undercapitalized. I had 100 people working for me that I couldn't pay payroll week to week. I didn't pay attention to details. You kind of touched on it a few minutes ago, asset management. You've got to be managing the manager, right? That's our job, is to manage the manager, and I didn't do that. I thought my partner and I thought my team had everything under control, and we'd pass in the hall and I'd say, how we doing? He'd say, oh, everything's great. Everything wasn't great, and I didn't know that. So, and then the 5th thing was that I didn't listen to people around me who were really important in my life and paying. I think people in our lives see things that we don't see because we're so close to it. And when somebody tells me today, hey, listen to this, I think I see this, I go, tell me more, and I didn't do that before. So those 5 mistakes I made. So ultimately what happened was, 2008 happened, the market went sideways, we started to come off the rails. I had 38 different companies at the time. I thought, well, the smart thing to do would be to take money from companies that were earning a profit, move that money over into negative cash flow companies, keep everything afloat. When the markets shift, put the money back. My accountant, my attorney both said it's okay to do that, leave a paper trail. I thought, this is a great plan. So we started doing that. Well, the problem was that we are in a very high transparency business. And Curt, if I borrow $1 from you, I have to report to you what I did with that dollar, right? If you invest $5 with me, what am I doing with that money? And I didn't do that. So I didn't tell my investors. So for non-disclosure, I wound up getting charged on wire fraud and mail fraud charges. I got sentenced to 10 years in federal prison and went away for 8 years.
Wow. And, it's a mistake that anybody could do. You had advisors. And, it's such an interesting story. And I think, you show a lot of inspiration to me, like from what you've built since then. Some people would just be done and say, what did I do? But I love that you're still, going stronger and you learned a ton from it. So what mindset did it take to get through that time and come out stronger like you have?
Interesting story. I'd gone from running marathons. And here are 2 things I always tell people. I say, look, I never flew private. I didn't have a boat. I didn't have a big fancy car. I didn't live in a fancy house. I was the neighborhood baseball coach. I was home most nights for dinner. And I got ripped from that lifestyle to live in a 12 by 12 room with 3 men I didn't know, nor did I like, wondering what the hell happened in my life. I'd gone from running marathons to being 35 pounds overweight and hated myself, and wondering what happened in my life, and probably would have killed myself. So I'm in prison probably about 6 weeks, walking around can't figure out how I'm going to get through today, much less 10 years. And I walk in the gym one day, and I was just window shopping. I wasn't looking to work out. But this guy's running a class, a cardio class. And he comes over and he says, look, he says, don't let these people beat you. All they ever want to do is take from you everything you've ever had. They can destroy your business, they can upset your family, but they can't take from you who you are and what you're made of. He goes, you can go back and build anything you want to build. He goes, what you need to do right now is focus on you. And you need to come to my class, start working out, and start losing weight. You'll start to feel better. And Curt, I don't know what happened, but it was like somebody flipped a switch, and I went, okay. And I don't know what made me say yes, but I started going to his class. I started working out. And it was that made me turn the corner. But I wound up going to college. I got a bachelor's degree in theology. I wrote 2 books while I was away. I taught real estate investing, property management for 6 years in prison. I was on an outreach program. I went in the community, told my story, did a number of other things, like started a Toastmasters group, and I reinvented myself. And it was because I didn't want to come home and be the same person I was. Pride and ego take over. You get wealthy and money starts to pour in, and you wonder, and I didn't want to be that guy today. And so that's what keeps me going today is I want to show people that you don't have to let your past define your future, and that no matter what's happened in your past, you can go out and achieve your dreams and your goals.
I love it. My next question was going to be, I know you're coaching, students, and we'll get into that in just a minute, but, how do you talk to your coaching clients about resilience, even if they haven't faced something like that in their past?
So our capital company is called Resilience Equity. Right?
Love it.
And, I think it's just the message, right? I think here's what I found over the years. There's a lot of people that are trapped in prison, and I might have been behind a wall, but these are people that are trapped from past sexual abuse, drug abuse, alcoholism, gambling, addictions, women in bad relationships, single moms that can't get unstuck. I don't care what it is, but you got to get out of that prison. And you don't have to stay there. And you don't have to let your past define your future or where you're headed. And if I tell my story publicly, or I'm on a podcast and I touch one person, I've done my job. That's where most of my energy comes from today, because it never fails. Every time I'm on a public stage, somebody comes up to me and says, "Oh, my brother just went to prison," or "I have a cousin that's in prison," or "Oh my God, I just came home," or I had a business guy walk up to me one day and goes, "Man, you have no idea." He goes, "I was just getting ready to start doing what you were talking about." And he goes, "I'm going to change my whole philosophy." So, I invariably always touch somebody and get somebody to think differently.
Yeah, and I can relate. Like you said, my brother was in prison for 12 years, like 2 different stints. Kind of got, like, what do you say? It even sounds like in your case, the punishment didn't really fit the crime.
Yeah.
And that's what happened to him as well. And he's doing great now. He stopped drinking, which was kind of the reason he went there, and bar fights and this and that. And he's a better person now.
Yeah.
But he said for him, he was young when he went, probably early 20s, and he goes, "Man, if I would have got out, I would have gone again."
Yeah.
It's sad to say, but he was like, "I needed a couple of years to get away from the people I was hanging out with and all that." And now he's doing great, and I'm really proud of him. But like you said, people can relate to that.
Yeah.
Somebody knows somebody that went to jail, whether it was a bad decision or accidental, what you did, a lot of business people may already have done and didn't get caught, or it's just such a
well, it's happening around us.
Is it?
I mean, in the industry that we're in, it's happening out there.
Yeah.
And, it's kind of sad, but, lost my train of thought.
That's all right. I get there a lot. Was there anything you learned in prison that actually made you a better business leader?
Yes. I think one of the biggest lessons I got by being in prison was not to overreact to any situation. I'm more calm today. I'm more focused than I was before. I was really scattered, and I was really a ready fire guy rather than a ready aim fire. I'm more, ready aim fire today, and I'm more calculated and strategic in what I do.
I love it, and that's something I've been working on even this year, is instead of reacting, I may react to a partner or something like the bank said, but then it's like, all right, let's react to internally and go, this is my first thought, and then let's talk about it, and then let's actually analyze it before we respond.
Yeah.
And it's something I'm still working on, and I think it comes with time, and I think it comes with really like dedicating to improving that skill.
Right.
For me, it's a skill or an emotion, right? Don't emotionally think strategically, especially most of the stuff I'm doing are business deals. So when the bank comes back and wants to charge me a higher rate, and I'm like, screw that bank,
Yeah, right.
Or you've already paid money for underwriting and due diligence and this fees, and then they change the terms. I mean, that happened to me recently, and I go, first step, I just don't want to do a deal with him.
Yeah.
And then I'm like, hold on, let's analyze their deal versus the other bank, and let's see what the real numbers are. Because when we're running investments, the numbers are the deal. So that's what it comes down to, not whether you like. I mean, we want to do business with people we like, but sometimes you're representing investors,
Well, the math doesn't really lie, So.
I love it. That's a great quote. Let's transition into your coaching. So I know you have a coaching program for multifamily investors. What inspired you to launch was it called My Core Intentions?
It's kind of my parent company, I guess. But I teach people how to do the multifamily investing business, how to syndicate deals, right? I think what we know how to do on 100 and 500 unit apartment complexes can be transmitted to 2-unit, 4-unit, 8-unit deals. And I teach people how to syndicate, how to underwrite, how to raise capital, how to pick markets, everything from setting goals, mindset, and having a life plan, where do you want to go with this, to operations and asset management and everything in between. So, I have some really good people that have come through my program. I have a good friend, he's a partner today, was in my coaching program 4 years ago, didn't have a multi-family deal that he had done, and today he owns over 600 units and, a couple industrial buildings. So, you can grow and learn a lot from it.
I'm a big believer in coaches. I've done some coaching myself, not in real estate, but like a pilot. I've been a pilot for 20 years, 18 years, and I here's one sitting here right here in the room with us, that I'm mentoring them, and I like it because I'm an expert at it, right? And so for me, I'm not an expert in real estate, but I am improving quickly because I pour a lot in. But somebody like you with 30 years experience, but I'm a firm believer in paying for coaches, and I consider it a hack. It is a shortcut to success. So people can pay a program like yours, learn multifamily, and what I tell people is that's the first step. First, find a good coach that works with you, right? That you really believe in, and someone that cares, because there's plenty of programs out there I've seen where they're just in it for the money. They need to hire someone like you. If somebody is listening here, hey, I want to be a multifamily investor, I'm not really the expert at all, right? I kind of skip the multifamily. Yeah. Go get, join Mike's coaching program because he actually cares. But then you got to follow the steps.
So something else on that. So I coached real estate agents when I was a realtor. I worked for a trainer. And so I have coached I've had thousands of hours of coaching, coaching other people, teaching them what to do. When I sold residential, my first 9 months in the business, I sold 78 houses because somebody coached me and told me what to go do and held me accountable. And I went and did that, and I exploded from that. And so it's not like I just went into coaching business. And here's the thing with coaches in the multifamily business today. There's a lot of them that have been in the business 3 years. and now they hang a shingle out and they're a coach. And have they been through a market cycle? Have they had a challenge? Listen, I might not have a spotless record, but I know what to avoid, and I know what to look out for, and I know how to help navigate through that. So, you know, and you don't have to coach with me, but coach with somebody who has had some time in the business and has had some experience, you know.
Yeah, and you're right. You've seen market cycles.
Yeah.
People that started investing, I would literally say since COVID, since 2020, it's only gone up.
Right.
So if somebody says, hey, I'm a new investor, I've been in it 3, 4, or 5 years, hold on. It's been the best time to make money in real estate.
Well, you're a genius when the wind's at your back.
Yeah. Yep. And like even for me, I wasn't investing in 2008. I was looking to. I decided to go all in on my pilot career to earn enough money to then invest. And that's what I did, and it worked out great. But people that have went through 2008, 2010, on that cycle, most people lost everything.
Yeah.
And how you came out of that is what is interesting to me, because that shows character. Not someone that necessarily lost all the investor money and screwed people over. There's a lot of people that did that and just walked away and restarted. But there's something to be said of learning from people that have been through the worst times is a total benefit.
Yeah.
What about, how do you define success now compared to how you defined it earlier in life?
Yeah, that's a great question. It seems like that comes up a lot. So I used to define success by the amount of money I earned, right? If I made $1 million a year, that was success for me. Mm-hmm. And it was always trying to achieve that. Today's success for me is the lifestyle I live, right? I live by the beach. I've always wanted to live by the beach. I have a great relationship with somebody I care a lot about. And, that's, I get to travel. I get to speak on stages. I get to do deals again. And for me, that's success. And success today is proving that I don't have to be defined by that 12 years of my life I lost. Now, I have a regret about that, right? And my biggest regret is I have 5 kids, and 3 of my kids don't talk to me. And I believe someday they will, but that's my biggest regret is that part of my life. But other than that, I wouldn't change a thing.
Yeah, and I think you learn from the past, but I think you spoke to me because I'm kind of going through a little bit of a life transition. Not even a reset.
Yeah.
I've been grinding for 5 years, headfirst in real estate, overworking really, jumping into deals a little too quick. Yeah, I made money, but it was like choosing the wrong partner because of the deal. Yeah. I didn't vet the partner as well. And I want to do business with people that are good people, that if I pass away or something happens, they'll call my family and check on my kids. Those are my partners right now, and that's who I want in my life.
Yeah.
And I was chasing money. I was making a lot of money. The problem that I found was, as soon as I started making a lot of money, I bought more cars, and then I bought a race car. And it's like, you want to reward yourself for hard work.
Yeah.
But now I'm resetting where I'm slowing down, doing business with people I want to do business, and really just kind of cutting expenses and realizing I don't need 3 cars.
Yeah.
I just get one average car, And so I think maybe that's why this question is going around a lot. It's kind of what I'm thinking, where I'm resetting. Success to me is not having to go to work for someone else every day, right? Kind of living your day by your terms and hanging out with my kids.
Yeah.
And as a father, it breaks my heart to hear that you got 5 kids and 3 don't talk. I hear that a lot from certain families, whether it's a divorce, the kids take one side. So I hope they come back and, reestablish a relationship.
Yeah.
To me, my family, my kids are young. They're 4.5 and 11 months, so they're definitely young. But it's like, I don't want to grind for 5 more years to make $10 million.
Yeah.
Like, what's it going to do? Not a lot. So I'm like reevaluating. I have a plan still. I still want to grow wealth, but I just don't want to grow it at a stress level.
Yeah.
I want to enjoy life and the beach.
Yeah, you don't need the stress, right?
Yeah, exactly right. Let's see. What's one thing you teach your students that surprises them the most?
I don't know that it surprises them, but one thing that that they need to know and understand is that this is a relationship business, and that nothing happens unless you have a relationship with a broker, unless you have a relationship with a investor. Our business is built on relationships, right? Because even if you and I don't do business together, I might know somebody who might do business with you. And I can say, hey, Curt, call this guy. Or you might need a resource, or I might need a resource, right? So because it's such a relationship business, and I think people come in the business thinking that it's more than that, and it's really not.
And I think it's something I learned as an investor when I started by myself buying single family duplexes. As soon as I wanted to start buying bigger deals, you need a network. And I'm in a coaching program myself, and this guy that's doing 10 times what I'm doing, he texted me the other day, and actually I reached out to him because we have the same coach, and he suggested I reach out to the guy, and he spent 30 minutes on the phone one day, which our time's valuable, like basically coaching me and tell me what he likes about the community and where I'm going. And we do similar business, but it's not exactly the same.
Yep.
And he's way ahead. He spent 30 minutes with me. And I'm like, hey, I really appreciate your time. I'm busy. I don't usually have 30 minutes for people. So thank you for that. And I owe you.
Yeah.
Well, the other day he texted me. He's like, hey, you're in Houston. Do you have a civil engineer? And I go, yes, I do. Here's their number and call. And guess what? They're doing his plans for self-storage in Houston.
Nice.
And I just saw them 2 days ago. And they go, thanks for the referral. And I go, well, I referred him to you because, number one, he's a great guy. And then you guys are good people. And you do my stuff. So like you said, relationship.
Yeah.
So you give a little bit and you don't expect anything back.
Right.
To me, that's the best kind of relationships.
100%.
It comes around one way or another someday.
Yeah.
But well, we'll wrap it up and keep it down to about an hour or so and respect your time. Couple last quick questions. What is like a favorite book that shaped how you think today?
Yeah, I've been thinking about this question, and I don't know that I have one book that has really shaped everything. I've read over 1,500 books. I read 400 books while I was locked up. And everything from business and relationships to biographies. But I read a book recently. Last year I read a book by Tim Grover. Tim Grover was Michael Jordan, Kobe Bryant's, personal coach. And the book's called Winning. And I absolutely love it. So if you need a good ass kicking, read that book. Because it got me motivated, and it got me thinking about, am I doing every day what needs to be done? Or am I just doing things to check things off my to-do list? Because we all feel great when we can check the boxes off the to-do list, right? But are they things that move the ball forward? Again, this is where a good coach comes in, right? Mm-hmm. And the book was written from a coach's standpoint of how to coach somebody and motivate somebody. It was great. It was a great book. But that's what I do with my coaching clients too, is, it's about accountability. So if you're in my partnership program, our goal is to get your first deal done. So I'm going to give you things to do, and I'm going to hold you accountable along the way to doing that. So
yeah, I mean, that's a great recommendation. I know the author. I haven't read one of his books yet, so I'm going to put that on my list. But I'll put it in the show notes for the listeners below. What about a daily non-negotiables that you have in your life today?
Time with the Lord.
Okay.
Totally non-negotiable. One question people ask is, how'd you get through that 10 years? Well, the only way I got through it was with my relationship with the Lord, But it's really, that part of my day is really important. And I'll tell you something interesting. You might find this interesting. So I'm a guy, I get up at 4 o'clock every morning. And, I've been feeling lately like 4 o'clock, I'm cramped. I got to be at the gym at 5. I just don't have enough time. So I started getting up 15 minutes earlier. And I just want people, I don't care if you get up at 6 or 5 or what time you get up 15 minutes earlier. Because by the time I get up and I make my bed and I get ready and I get dressed, and now I have an hour before the gym opens, and I get to really have my coffee, do a little meditation, spend some time with the Lord, then go to the gym and work out. But our morning routine is, for me, my morning routine is so powerful, and I have to have that.
Yeah, it's a great one. If someone's listening right now and they're struggling, whether it's in life or business, what would you say to them?
I don't know that I'd say anything. I'd listen to why, right? Because a lot of times I think we say things to people and they don't really want us to say anything, you know? Maybe your wife, maybe a relationship you're in, right? You know, frustrated, mad. All they want you to do is listen. But I'll always ask, you know, do I need to say something? I think a piece of advice that I could give, it'd be that you don't have to let it destroy you, right? Because in 6 months from now, it's not gonna be there anymore.
Yeah, it's a great answer to that question. I think, you know, I would say like tomorrow's a new day. Like, don't let today drag on tomorrow, right? And you don't always have to solve the answer quickly.
Right.
You know, I think that's the difference between men and women. You hit it on the relationship side. Women they want you to listen.
Yeah.
Men, our brains are to solve the problem.
Right.
And it's kind of like always a communication problem between men and women.
Yeah, we're fixers.
We
want
fixers.
to fix it.
And most of the time, they don't want us to fix. They want to vent.
Well, and I find that even too with you know, friends in my life, right? Guys that are struggling, they don't want you to fix it sometimes. They just want you to, you know, and they'll say, you know, give me some ideas. Do you have any thoughts? Or, you know, that's a whole different conversation, right?
Yeah, I agree. Well, we'll wrap it up. Thanks for your time. And where can people find you to connect with you?
Yeah, I appreciate it. And I have a gift for you, by the way.
Oh, great.
I wrote a book. This was an Amazon bestseller. Multifamily Investment Secrets, Your Explosive Guide to Wealth in the Multifamily Business. I want to give you a copy.
Thanks so much for that.
And thanks for asking, because people can find me anywhere you hang out on social media. It's where we connected on Instagram.
That's right.
But whether you're on LinkedIn, Facebook, Instagram, YouTube, you know, you can find me anywhere there. And I love to connect with people. So shoot me a DM or email me at mike@mikemorawski.com. Love to have a conversation with you, you know, even if it's a 30-minute conversation, right? If I can help, I will certainly try and do that. Or if you're looking for coaching or looking for opportunities, you know, reach out.
I love it. Well, thanks so much for your time. Glad we connect. I'll put all Mike's info in the show notes, so you can just click down there and connect right to Mike. And thanks for sharing your story, and look forward to building a relationship later on.
Yeah, thanks. Thanks for having me on.
All right, thanks, guys, for this week. I hope you enjoyed the show. We'll see you next week.